Welcome to this week's episode of DoubleLine Minutes. I'm Sam Lau here with Mr. Mark Kimbrough.
Hey, hey.
All right, Mr. Kimbrough, it's 10 a.m., just after 10 a.m. Pacific time here on August 30th in Los Angeles. We're just pretty much winding down uh, the summer here with the unofficial end of summer coming next Monday with Labor Day. So a lot to look forward to there. I expect the desk to start getting a little bit busier in terms of activity as well. So it's been pretty quiet through this last summer, and nothing too eventful, despite some of the goings on in the market. Still, the uncertainty around that began in the early part of the summer with what Fed monetary policy was going to look like has gotten a little bit more clarity. But with that, we've got the monthly roundup of the market, so we'll just go ahead and kick off on that with the "Where are we?" section and what it's looking like right now for the equity markets. The S&P 500 is down about half a point as we on this early record for the week. Month to date looking pretty strong. The S&P 500 up over 1.5% on that month to date basis. It's really being led by looks like consumer staples up over 5%. Real estate and utilities just shy of 5% on the month to date thus far. We'll see if real estate's pretty close there. It's at 4.9% right now, but it does look like it's down 50 bips for the week. So we'll see if it can climb over the 5% mark to close out the month of August. Everything else, with the exception of consumer discretionary and energy, so far holding on to the positive territory, but energy down almost 3% on the week, the month to date, and then consumer discretionary down over a point. For the year to date basis, the S&P 500 is up just over 18%. So definitely a strong showing from the S&P 500 to at this point in the year. Looking across at some of the other equity indices that we monitor here, starting with the Russell 1000. That's up just about a point and a quarter for the month to date basis, up over 17% year to date. So pretty close to what we're seeing with the S&P 500 over those windows of time. The small cap, the counterpart to the Russell 1000, is down 2.5% on the month to date basis, but still up 9% on the year to date, and that's represented by the Russell 2000. When we take a look at growth versus value, the Russell 1000 growth up 90 basis points on the month-to-date basis versus the Russell 1000 up almost 2% on the Russell 1000 value for the month-to-date basis there, but both doing quite well on the year-to-date basis. The Russell 1000 growth outpacing the S&P 500 for the winner of these five indices. That's up almost 20% on the year-to-date basis, but the Russell 1000 value not doing too poorly. It's up 14% year-to-date there. So across the board, pretty much a clean sweep across the U.S. equity front. So no matter how you slice it, when you look at these broader aggregate indices. Moving over to the fixed income, starting out with Treasuries here. Looks like on the month-to-date basis, yields rallied. We got the 2-year note at a yield of 3.92 as of the time of this recording. Pretty much flat to where we were last week, last Friday at the close, but on a month-to-date basis, it's a pretty strong rally here. It ended July at a yield of 4.26. We're sitting here at a yield of 3.92 as we stand right now. So it's a rally of about 34 basis points right now in the 2-year yield, and that pretty much matches what the move in yield on the year-to-date basis as well for the 2-year note. On the 10-year Treasury here, we are sitting at a yield of 3.91. So pretty much just flat, a flat curve. The way we look at it right there, it's inverted by just a basis points there. So it is going to be an interesting take if we do uninvert here and go back into a normal curve if the 10-year yield breaks above the 2-year in a meaningful way. In the past, as we've talked about here on the minutes, is that tends to be a pretty reliable indicator of an impending recession after being inverted going into a normalized curve there, as something that has been reflective of a recession that comes within, if memory serves, somewhere around within the next 6 months. when taking a look at, I believe it was eight of the last 9 recessions or so. So pretty good track record there. It certainly doesn't feel like the case today based on what we're seeing in the macroeconomic data. But we'll talk a little bit more about that as we round out the week's events in terms of macro. But from that, that's something that will be interesting to keep an eye on for that the spread between the 2-year Treasury and the 10-year Treasury. And then when we move over to the 30-year bond, right now we're seeing a yield of 4.2%. That's 11 basis points lower than where it started the month at. So definitely a bit of a rally there as well. So looking across the curve right now, when we on the year-to-date basis, the 10-year is pretty much also flat to where it started out the year, but the 30-year bond is 17 basis points above. So that one there is still has a little bit of ways to move before we get to a lower point than when we started out the year. Moving over to the broader bond index here, the U.S. Bloomberg bond aggregate is down about 0.5 point here on the week-to-date basis. Month-to-date, though, almost matching the S&P 500 in terms of the performance there. It's up 1.5% right now as the time of this recording for the month-to-date basis. Year-to-date, it's up just over 3%. So pretty good year for the fixed income market as well as the U.S. equity market there for those who have that 60-40 type of allocation. Yeah, pretty good. 2024 is starting out to be a very good year for your portfolios. But looking across the entire spectrum of sectors that we cover here, all sectors are in the green for the month-to-date basis, being led by emerging market sovereign debt, up over 2%. IG corporate credit, just 7 basis shy of 2% positive on the month-to-date basis. Everything else that we cover here is up over 1%. Bank loans is the laggard, up just 1.1% on the month-to-date basis. Next is high yield, up 1.5%. And then we have Treasuries there about 1.5%, and then MBS also at about 1.5% positive performance. So a clean sweep on the month-to-date basis across from the spectrum for fixed income. Moving over to commodities, it sure doesn't feel like it, but it looks like we're just a little bit positive here on the Bloomberg Commodity Index, about 10 basis points positive for the month to date. See if it can hold on to that through the rest of the day. But on a year-to-date basis, commodities is still holding on to a 1% positive performance there. Certainly not helping that performance has been the energy side of things, with WTI crude oil front month futures down about 5.5% on the month-to-date basis. Still holding on to this price return that's positive, of just about 3% positive on the year-to-date basis, but it has been struggling of late. I see the entire energy complex as measured through the Bloomberg Commodity Index there is down over 4% on the month. Helping out, though, is gold. Gold has certainly been enjoying some of this talk around the next direction in the Fed funds target rate there. It's up over $2,500 a troy ounce. Right now it's at $2,507 a troy ounce. That's up about 3.5% on a month-to-date basis for that front month futures contract there. And on the year-to-date basis, it's up 21%. So overall, things are looking quite positive across all three of these major sectors that we carry in terms of our major asset classes that we cover here on Monday Morning Minutes for the year thus far through August 30th, 2024. But with that, Mark, do you want to kick us off on what happened this past week in the macro front?
Yeah, let's wrap up this week and I guess wrap up the month in summer. I mean, it's been one heck of a month of July or of August, that transition from July to August. So I guess let's dive right in. On Monday, we had prelim durable goods orders being released for July. We had the headline metric printing 9.9%, ahead of estimates of 5%. This is a pretty nice bounce from the prior month print of negative 6.9%. That's kind of standard volatility here as aircraft orders really move the needle. Let's smooth that ball out a little bit and let's look at the year-over-year number. We're up 3% year-over-year for the durable goods orders. If you want to strip out that volatile transportation component, we get the durables X transportation, which printed negative 0.2%. slightly below the negative 1.1% estimate. I mean, in general, with these, I just want to point out that there's been various economic business surveys that have come out, and a lot of the respondents have made comments about holding off on any big investments given election uncertainty. You also have, impending Fed rate cuts. So there's a little bit of an explanation if you want to try and rationalize a little of this local softness here. But I mean, it's manufacturing data in general, anything related to it's been soft. So this is just kind of ongoing there. Moving forward to Tuesday, we had S&P CoreLogic home price indices for June. We had the 20-city month-over-month measure coming in at 42 bips, just ahead of the estimates at 30 bips. That brings the year-over-year 20-city measure down to 6.47 from the prior 6.88. Expanding that to the U.S. broad measure, that printed year-over-year at 5.42. In general, when you're looking at home prices, we're seeing faster growth still in major metro areas relative to the rest of the country, but everything still is growing at a very robust pace. Moving forward, also on Tuesday, actually, we had the Conference Board Consumer Confidence for August. Small improvement for the headline print, came in at 103.3 versus estimates of 100.7, and prior was 101.9. So small improvement, but all in all, this metric has been treading water. The headline consumer confidence print has been treading water since basically 2022. It's been a mix of consumers that are consistently pleased with the present and are consistently pessimistic about the future. And the two have yet to meet. We're waiting for those two. They're starting to kind of inch together, but it's not. We're waiting on the two to meet. Moving forward to Thursday, we got the second estimate for the second quarter GDP for the U.S. The surprise to the upside, increasing from an advanced estimate of 2.8%, increasing to 3%. Most of this upside you can attribute to a revision to personal consumption, and it actually hit both goods and services. I'm going to dig into this briefly, even though it's revision data. The goods contribution to GDP increased from 55 bips to 65 bips. And the services consumption contribution increased from 102 bips to 130 bips. So net, you got 38 bips of an upward revision coming from the consumption basket. And that's modestly tampered down by the other three major categories: private investment or gross private investment, net exports, and government consumption. I'll talk a little bit out of it. But specifically this goods number, I just want to give a little brief history here. 2022, all four quarters very weak. 2023, all four quarters very strong. We bounced back firmly. But Q1 of this year, and I'm sorry, I'm speaking again, goods consumption. Q1 of this year, we had a pretty sizable drop. We had a negative 2.3% decline in goods consumption, which was a negative 51 bip contribution. That is more than the contribution of all the weakness in 2022. So it seemed a little concerning there. But we got this nice snapback. Like I said, we contributed 65 bips with goods consumption. So all in all, firm GDP print continuing. We'll see how Q3 comes out, but we still have one more revision coming for this. Also on Thursday, we had initial and continuing claims for the weeks ending August 24th and 17th, respectively. Both prints came in just below estimates. Your initial claims printing 231K, while continuing claims came out with 1.868 million. But try and keep focus on the 4-week moving averages. We had initial claims. The 4-week moving average of initial claims now has declined for 3 consecutive weeks. It's basically right in line with the print we got today. So that summer rise we saw, we've talked about this repeatedly, but that summer rise seems to have lost a little bit of its steam. We're still in the range that's persisted since January 2022. So see that continues to develop. The 4-week moving average continuing claims is now at 1.863 million. That's just below the print from this week. But we've been materially unchanged for the past 4 weeks. There was a 12-week consecutive rise in that 4-week moving average that has recently petered out a little bit. So, resilience to the labor market, even though it has weakened from where we were not too long ago. Finally, today, we had 2 big releases. This is the kind of meat of the week. There's not too much we need to dig into. We had personal income and spending for July. Both measures printed near their 20-year trailing averages of 0.4%. We had personal income printing at 0.3% versus estimates of 0.2%. And we had personal spending coming right in line with estimates printing 0.5%. That brings some year-over-year numbers into this. That brings year-over-year personal income up to 4.4%, while year-over-year personal spending is growing at 5.3% year-over-year. I want to say that again, the spending numbers higher than the income. We continue to have spending growth that is outpacing income growth. Not sustainable forever. We've talked about rises in what is it, in revolving credit card spending, revolving debt growth. So we'll see how long that can continue. But looking at the details, within income, compensation growth was up 34 bips month over month. That was a 21 bit contribution to the headline prints. In general, take the trailing 6 months. I'm going to break the income report down. And if you take the trailing 6 months, compensation is giving you on an annualized basis about 3% per year, while transfer payments are giving you about 1%. So your wages and your benefits plus transfer payments, you get about 4% year over year right now. Slower than the year over year overall income report, but the rest of that, you have to pay a little bit of the money out into the government for those benefits that are coming back your way, as well as asset returns. But it's still firm income growth that we're seeing. It's not decelerating in any sort of scary way. It's still quite firm. Spending, you still have your normal mix, 1/3 goods, 1/3 services. You had 71 bips of growth for the goods, and you had 45 bips of growth for the services. It's still firm. You said it was 0.5% month over month for spending growth. And lastly, today we had PCE price indices get released for July. Since the Fed cares most about core, we will care most about core. Core PC month over month printed at 0.2%. There was a 0.16 on a rounded basis. That's exactly in line with the prior print of 0.16%. That left the year over year number unchanged at 2.6%. Slightly below estimates, but these are very accurate. We're going to call that rounded. I mean, the rest of the year, it's going to be a bit of a tough slog to be able to get core PCE down much further on the year over year basis. The average month over month roll off is 16 bips. One of those is actually material. It's a 33 bip roll off we've got coming through in September. But the rest of the year, these are pretty low prints we're going to have to contend with. We want to see a lower core PCE until we get to next year and deal with the first 4 months of this year where we had some robust inflation numbers get released. But all in all, that kind of wraps up this week heading into our long weekend, the end of summer.
All right. So taking a look this past week with regards to Fed speak, it was a pretty light calendar. There's a few speakers out, but no one really added anything additional to what we heard from Jay Powell last Friday. And when I take a look at the impact that this week has had on the Fed funds futures and the probability of rate cuts going in the next few meetings here, for the most part, it seems pretty consistent with what we reported in the last minutes there, seeing about a 30% chance or so of a 50 basis point cut at the September meeting. That's a little bit inside of where we were last week, but for the most part, 25 basis point is what the market's pricing in terms of a cut for the September meeting, with a slight, 30, call it a third chance for 50 basis points. So we'll continue to monitor that as we get closer here, but it really just depends on what the next prints look like for both the CPI and the payrolls data, which is upcoming next week there. So that's definitely going to be an important data point to watch coming forward with regards to Fed funds policy. But as of right now, we're still the market's still pricing in 100 basis points of total cuts for the rest of the year in 2024. In terms of things to keep an eye on for next week, we have the ISM manufacturing data coming out on Tuesday, September 3rd, to start out the week, the business week at least. It's expected to remain in contractionary territory, but a bit of a step up in terms of the right direction, moving up to 47.5 on the estimate from 46.8 the previous month. The following day on Wednesday, September 4th, we'll get the jobs openings as reflected by the JOLTS data. It's expected to be pretty much in line with where we were the previous month at 8.1 million job openings. Then on Thursday, we'll have the ISM Services Index that's expected to remain in expansionary territory at 50.9 right now as of the early look. And then on Friday, we have Pizza Friday, first Friday of the month. There we'll have the non-farm payrolls data as well as the unemployment data. So those are the big things to keep an eye on for next week, with the change in non-farm payrolls for the month of August expected to come in at 165,000 payrolls there for that month. Hopefully, we'll see that type of improvement from that disappointing number that we saw in the month of July with 114,000 for that, which was a big miss in terms of what was projected to be relative to estimates there. And then taking a look here, the early look for the U3 unemployment rate, the headline unemployment rate is expected to tick down by 10 basis points to a level of 4.2%. Labor participation rate is expected to be the same. And then right now, just as a reminder, we had the U6, the broader measure of unemployment, that was at 7.8. They don't put out a economist forecast for that, so we'll just watch to see how that moves on that week's data print. So that pretty much closes out. Not many data points there, but certainly some key ones that the market does pay attention to. So we'll be tuning in and letting listeners know our thoughts on that next week. But that pretty much wraps it up for this week. I want to thank everyone for tuning in to DoubleLine Minutes.
Yes, thanks to all our listeners out there today on DL Minutes. Hit us up on the X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
All right. And don't forget you can subscribe to our YouTube channel to find out more about DoubleLine and what some of our portfolio managers and the investment team have to say. I'm told that we will have a piece from our macro asset allocation team where Ryan Kimball is going to be talking about the debt spiral. That's going to be posted on our YouTube channel sometime today. And you can also check out a repost of Jeff Sherman, our deputy CIO's recent interview from yesterday, where he was speaking with the folks over there at CNBC about opportunities in the bond market. You can find that reposted to right here at D-Line Minutes on the X. But want to thank everyone for tuning in and hope everyone has a great weekend and good luck out there.
Yeah, thanks everyone. Stay safe out there. Enjoy the long weekend.